So today's Cardinal lesson, you're in for a real treat. We've got EJ here, who's a client. He's a physician and been with us since 2022. And really had an experience with all 7 of the worries. So I just want to push it to you and welcome you, EJ.
Thank you. Yeah, I mean, I first met you guys in 2022. You weren't, I mean, I was studying this for about a year. I looked at a couple of major national companies. I looked at some local companies here at home, and I looked online. And you clicked with me for a couple of reasons. First, we're exactly the same age, Hans and I. And I sense that you're an educator, and I've been running an internship and residency training program at the hospital for 17 years. So I'm an educator also. And for those 2 reasons, I felt like it was a kindred spirit, and you made sense to me. And that's why I contacted you back in 2022 now.
That's
Yeah.
fabulous.
Yep.
Tom?
Yeah, I mean, I'm a little bit surprised, EJ, you weren't drawn to my age, but that's okay. That's for another thing. But what I want to do today, what we're going to do through the video is we're going to sort of walk through each of the 7 worries and really just let EJ talk to you guys a little bit about what his experience was. I do want to point out, like, everyone's situation is different, right? This is EJ's experience. Another client's experience is completely different. They have different concerns, different issues, different things to consider. So it's all very personal, but it gives you a general idea of how we approach this stuff. And so I want to bring up the show notes. Again, the show notes today are pretty light. They're really just the board. You know, you can print them out, you can look at them, but mostly I really just want you to watch the video, listen to EJ's experience, how all of these 7 worries have impacted him and his family, and sort of how we approach them from a planning perspective. And so what we're going to do in the video is we're going to go worry by worry. We'll prompt EJ and have him give a little bit of information about his experience with Cardinal and how we addressed each one. So Hans, I'll let you start and we'll just sort of go down the list here.
Okay, let's get really going. We're going to talk. EJ, tell us about your experience and what you're learning and what your decisions are going to be around Social Security.
Well, in our case, you recommended, and I thought all along that we should wait till 70 to claim Social Security for a couple of reasons. First, the amount is permanently reduced if we claim earlier. And the 2 of us, my wife and I, have a history of longevity in both of our families. So it made sense to delay it as long as possible. Now, she worked only 38 quarters, 9.5 years. So she put money into the Social Security system for 9.5 years, but then she was ineligible to collect based on her work record. But we've been filing jointly for years and years now. So she will get, when we claim, she will get 50% of my Social Security payment at my full retirement age. Now, but she won't get that till I claim. So I learned that from you guys. I thought she could claim at 62 herself, but I learned that she cannot claim her Social Security payments until I claim mine at age 70. And one of the things I also learned from you guys is, and that was way back in 2023 when you sent me the report, was that by delaying Social Security claiming till age 70, it opens up more years for Roth conversions. So we've been doing that as well. Hans?
Yeah. So with Social Security, the spousal benefit, our situations are very similar. So I just filed for my Social Security. And the reason I did it is my wife just reached full retirement age. I'm a little over 68. And I just started to look at her Social Security check was like $700, $800 a month. And that's what it's going to be. And she was going to file for that at her full retirement age. But then when we looked at her spousal benefit, it was $2,000 a month or $2,100 a month based upon 50% of my full retirement age. But I needed to file first. So I ran all the numbers on everything and I decided to give up the $900 a month that I would get at 70 to have her get $2,000 a month. Anyhow, not too much on my deal, but
Well, that makes sense. In your case, she had a work history and she was going to collect on her own. And in my case,
correct.
she does not. Yeah.
That's correct. So what we want to do is we just want to push it to Tom, and Tom wants to ask you about Medicare.
Yeah, so I mean, Medicare, if if I'm right, if I remember right, I think that's maybe one of the first videos that you originally found us on is around Medicare and sort of learning
Exactly.
about that and making decisions around that. So why don't you talk a little bit about what we taught you in maybe the videos or through our planning and our work? What was it that we helped you come to a decision on, and just walk us through sort of the decision around Medicare and when to file and what to do with that.
Well, I had switched employers, and my new employer was a smaller group, not creditable, not, as you said, not more than 20 employees. So I had to get on Medicare at 65, my wife and I. And we discussed supplement versus advantage, and we ended up going with the Cadillac of plans, what we think and you seem to support is the best plan, which is Medicare Supplement Plan G. So we did that. One of my colleagues at work had screwed this all up, by the way. He didn't sign up for Medicare on time, and for the rest of his life, he's been paying penalties or extra premiums on Part B and Part D, permanently increased because he didn't sign up at the right time. The mistake that we did make, and you taught me, I think it was Tom that I contacted at the time. I had been funding the family HSA account every January, every year. And the year I turned 65, I funded it in January of that year, not knowing that once we get on Medicare, you can no longer do that. So I reached out to you guys, and you taught me what to do. I had to contact the HSA custodian and remove part of the money, I think 4 months worth of the money from that account because of the August birth. So we did that. And that was one thing that I learned from you guys. Somewhere halfway through my 65th year, I had major surgery, and it was an enormous bill. But between Medicare and Supplement Plan G, it cost me next to nothing for this big surgery. You also taught me about IRMA, and that's the Medicare surcharge for high earners. And I've been paying into that now. I've been getting the letter every November about how the following year's IRMA surcharge is going to be this much. Couple of years ago, because of decreasing amounts of Roth conversions, I reached out to you guys, and you taught me how to fill out the form to appeal IRMA. So that's another thing I learned from you guys related to Medicare. Tom?
Yeah, I mean, I think one of the other things that we recommended the supplement for as one was the better the coverage is really good, right? You don't have to worry about networks, which is a big piece, right? I mean, if you're traveling around, if you have family in different states, or maybe you have a second home, maybe not you specifically, but just in general, you can use these supplements wherever you want, right? You don't have to check, do they take my plan, do they not? And you, like you talked about your colleague, this is something people often miss, and it tends to be the people who maybe own their own business or work in a small practice or things like that, where they just sort of have group coverage. They're not really focused on the health insurance because they're working and focusing on that, and they miss this window to sign up because they just think, oh, I have group coverage, I don't need to do it. And it's very important, is if you have less than 20 employees in your group plan, you need to sign up at 65. Now, in another scenario, like if you were still working for a big hospital or a big practice, we would have recommended delaying Medicare, because by signing up, we've intentionally are having you pay IRMA, but what we're avoiding is that penalty, like your colleague is having to pay because they missed that.
Yeah.
So it's very nuanced, right? And that's why a lot of this needs to be done as part of a planning process, because everyone's situation is different. And so again, there's a lot of intricacies that you got to make sure that you don't miss. And something as simple as like, when do I sign up, seems like sort of it doesn't really matter that much, but at the end of the day, it could come with some penalties, and like you mentioned, their lifetime. And I never want to pay something for the rest of my life if I don't have to. And so it's something to certainly keep track of. And so
Yep.
let me
Yep.
turn it
Yep.
to Drew, and I'll let Drew sort of ask about the long-term care.
Sure. So, EJ, you and your wife had to take different approaches to planning for long-term care. Can you talk to us, one, what made you want to take planning for long-term care seriously for you and your family? And then also, what approaches did you and your wife end up landing on?
Well, I mean, long-term care has always been one of our overarching concerns. We don't want our kids to be changing our diapers, down the road. But also, it's, to me, having a guaranteed income in retirement that pays for that for that nurse's aide that comes to your house to take care of you. I mean, long-term care doesn't mean nursing home. Long-term care to me, ideally, staying at home, having a nurse's aide come to the house. Next level, assisted living or one of those continuing care retirement communities. Uh, that is what long-term care is, and we wanted that covered. I don't want the kids to be sitting there going, geez, we're losing part of our retirement money, part of their inheritance because we have to pay for this long-term care facility. I want to guarantee that's already covered. And we knew all along that we wanted a hybrid form of long-term care policy because hybrid forms allow the beneficiaries to take whatever unused balance is at the end of life. And we wanted a hybrid policy. So we looked at hybrid life insurance long-term care policies, and working with you guys, we bought one for my wife using my traditional IRA money. I didn't qualify at the time because I was going through this health issue a few years back. So I didn't get that, the long-term care life insurance policy with long-term care hybrid. So we bought it for my wife using a lump sum from my traditional IRA. And you recommended that I buy something short-term just in case. And we bought something short-term for me. And so it was a short-term policy that covers just 2 years, one at home, one at a home. More recently, though, you told me about this hybrid annuity long-term care policy with easier underwriting. So we went ahead and bought that for myself, and that comes out of non-traditional IRA money. That comes out of cash money. So we did that. There was a time when we were thinking about buying annuities, and I'll talk to annuities probably later on when we talk about income. But what I didn't know is that you could add a long-term care rider onto annuities, and that's something you recommended. You said, how about when you buy those annuities, you buy a long-term care rider attached to it, which then doubles the amount the annuities give you. And we did that. And again, we made sure all these things had beneficiaries for our kids in case there's a balance in any of those accounts. Drew, any questions?
No, that's great. And I think when we start planning and considering insurance as part of a funding mechanism for long-term care, a lot of our clients share your sentiment, which is, one, we want things to be easy for the kids, easy for the family, because it's already tough dealing with someone being sick. But when we start talking about the actual solutions, you found comfort, it sounds like, in having a guaranteed source that you knew you could
Right.
rely on,
Right.
regardless of what took place with the other investments. Would you say that's fair?
That's fair. And comfort, not just for us, for me, but comfort for the kids as well.
It's great. Well, let's move on to Hans here and talk about the next worry.
Yeah. So now we're going to talk IRA 401k, which really involves RMDs,
Yep.
Roth conversions,
Yep.
and then beneficiaries or inherited IRAs. So ultimately for your kids, it involves the widow's tax. When one of you passes away and inherits the whole IRA, then the tax rates go up. So I'll put it to you to tell your story with IRA 401k.
Well, I mean, we opened the Roth IRA. I opened the Roth IRA like 15 when George W. Bush was president, and we were allowed to convert from a traditional IRA to a Roth IRA. I think that's when it started, like
Yep.
2009 or 2010. And we've been converting small amounts from traditional to Roth with our brokers, our custodian. In our case, there's numerous reasons why Roth conversions make sense. The required minimum distributions at age 73 could have been enormous for us and would have then triggered taxes on Social Security, Medicare surcharge taxes, the IRMA surcharge. So we didn't want that. So we wanted to decrease our eventual RMDs. You mentioned about the kids. If the kids inherit taxable traditional IRA money during their prime earning years, now their tax rate will go up not only on what they inherited, but they're also on the money that they're making off their own income. And then the third thing is that solo aging business. And as you said, taxes in the bracket that says married filing jointly versus the bracket that says single filer, the amount of money that the widower would have had to pay in the single filer bracket is so high on the RMDs that it would be horrible. So we felt that it was better to prepay those taxes as married filing jointly rather than wait for that. And then more recently, the fixed index annuities we bought through you guys with the insurance companies, we've been paying taxes on that conversion as well. So now when we're ready to annuitize those annuities, they'll be in Roth. They'll come to us tax-free. And I mean, Ed Slott was a big name in your world and the retirement planning world. He says that his own annuities are in his Roth account as well. And I think, Hans, you said the same thing, that they're in your Roth account as well. And I think
They
that
are.
makes it safer, you know. I had one more comment in this, and that has to do with Secure 2. When Secure 2 came out, and it had this enormous senior bonus deduction of $12,000 per couple, there was a cap at $150,000. And by doing the last two annuity conversions to Roth, we would have jumped over the $150,000 in the 2 years that we had to do that, 2026, 2027. So I reached out to you guys, said, does it make sense? Should I just hold off on Roth conversions in 2026, 27 and take advantage of the $12,000 deduction? And then in which case we would have had to use Roth money to live off of. And we did the math together, and you recommended, and I agreed, that we should forego that extra large deduction for those 2 years. Tom?
Yeah, I mean, I think one of the things is speaking to that extra deduction, right? I mean, it's a nice provision that was included in Trump's one big beautiful bill, where it was an additional $6,000 deduction per person if you're over 65. But like EJ mentioned, it had a cap, an income cap. And now some situations we want to take advantage of that, right? We want to look to see, hey, this is worth it. We want to do planning around that to preserve the ability to take it. In EJ's situation, the benefit of the Roth conversions for the long term made more sense than trying to keep our income lower and preserve that cap. So again, it's different person to person. But that again, that's why we want to take a look at the whole picture and not just focus in on one individual piece, right? Because if we just looked at that cap, I could sit here and make a great case. Like, yeah, we should keep our income really low. Let's get that as an additional deduction. This is great. But it's a lot of that planning is short-sighted. It's not long-term planning, and that's what we really want to do in financial planning, is not look at just right now, but also look to the future and see what's going to be the biggest benefit for you, the client. Sort of the next section on the next worry is around income, and ultimately this is one of the bigger pieces that we do with most of the plans we're focusing on, is how to create income, right? Because most people that we're working with, most clients, they come in, they've been good savers, they've invested well, they have this pot of money, but their whole life has been on accumulation. It's about building up the accounts and getting to some arbitrary date where they're going to have to live off of it. And one of the things that is interesting to me is we see a lot of people come in and have a really hard time spending that money when they get there. And so we need to come up with sort of an income plan. So EJ, talk to us a little bit about what your plan is around income, and once you do eventually retire, what that looks like for you and your wife.
Well, we're no longer in the accumulation phase. We're in the decumulation phase for the last year and a half. I've cut back on my work. I'm slowly, I don't want to go from working 60 hours a week to nothing. So I've been slowly, gradually decreasing my workload since age 65. So for now, we haven't claimed Social Security. So for now, we're living off of my income, my decreasing income, and also some traditional IRA withdrawals. Down the road, when I fully retire, Social Security will have been triggered, plus the fixed index annuities that are in the Roth account. Those two should cover 99% of all our monthly expenses. That's one of the reasons why we bought the amount of annuities that we bought, is to get to the point where we'll be comfortable in retirement with all that money. We'll also have a large Roth IRA on the side that we can always tap into for inflation. So over the years, we've maximized our Social Security checks by decreasing the RMDs, therefore less tax on Social Security, by waiting till age 70 for the Social Security claiming. We're minimizing our RMDs. We've Rothified our annuities. Um, annuities are a bond replacement. I mean, people who criticize annuities compare them to stocks. We don't. Stock annuities are bonds. Yeah, that's what insurance companies buy, bonds to cover the annuities as it is. So instead of me buying the bonds, I'm having the insurance companies buy the bonds. And as long as the insurance company is A rated, A plus rated, they're going to give us money every month for the rest of our life till the last one of us dies, you know. Um, People say you're supposed to be 60-40 stocks bonds or 70-30 stocks bonds. Well, it's that 30 or 40% that we used. That's the money we used to buy annuities to replace bonds. I don't want to see what happened in 2020 when bonds tanked by 20%. So much for safe bonds. They dropped 20%, you know. So that's why we did what we did. Another famous researcher in retirement is Wade Pfau, and he talks about this, and he says that annuities are a very good bond replacement, and that's why we did that. We listened to you guys, we listened to Wade Pfau, we listened to Ed Slott, and that's who recommended these things. So instead of me buying bonds, let insurance companies buy bonds. You know, it who said annuities give you a license to spend? You know, it does. It in retirement, I don't have to worry. A lot of people out there in retirement are afraid to spend money. Supposedly, the biggest worry people have in retirement is to run out of money. But really, the biggest problem in retirement is people end up accumulating more money in retirement, and they end up dying with more money than back when they retired. I don't want that to happen. I want to feel comfortable spending money, and that's what annuities do for us. You know.
I mean, I think that's a great point, and we see it a lot of times, right? Is people get to this retirement date and they've saved well, and they're typically not doing stuff they want to do, but they're not doing as much as they could either, right? They're not spending the money that they could support for a couple reasons. One, they're worried about running out because we don't know, none of us know how long we're going to live, right? We don't have that crystal ball. And two, a lot of them are worried about possibly needing it in the future. And then a lot of times I'll look at them and say, well, you're not spending it now, what are you going to need it in the future for? A big answer is long-term care. And so I think in EJ's plan, what we did is we planned for the long-term care. So we've covered that risk on the one side. We've set up income from delaying Social Security, adding the annuities to have another guaranteed source of income. So now we're not worried about market fluctuations. We're not worrying about bond values decreasing like happened in 2022, like you mentioned. And we're moving forward. So now we've covered our income basis from guaranteed sources. And we have the rest of the money invested for growth. That's going to be the inflation hedge. That's going to be the inheritance for the kids. In your situation, you've converted most of that to Roth, so it's tax-free inheritance to them. And if you and your wife just want to go take a trip or go do something, we have a big pot of money that we can pull from and not mess up the tax planning we did with all the other pieces of it because it's now in a Roth account. And so again, it's, you know, as you can see, a lot of these interact with each other, right? One decision in one area impacts decisions in two or three of these other areas, and that's why we want to build this as part of a larger plan. Drew?
Yeah, moving on to estate planning, EJ. So, what things did you do within the estate planning space that help you and your wife out now and also consider the next generation?
Well, your estate planning in my mind is four things, right? Paperwork, widower, kids, and charity. You know, for the paperwork part, many years ago, we created wills and powers of attorneys and medical power of attorneys and living trusts. We updated those about 2 years ago. Um, as an aside, it's very important to list beneficiaries, not just living trusts and wills. We went to the banks and made sure they had beneficiaries. We talked to our custodian, made sure it was taken care of on the brokerage side, and the long-term care policies have the kids as beneficiaries. Those things we thought were important, so we did all that. For the widower, the I think we fixed a lot of problems that the solo ager will have. A solo ager will have a smaller Social Security because the smaller check stops. If there's still large RMDs, they have to pay the single filer tax rates. The IRMA surcharge brackets are also on the single filer side. They're also very high compared to married filing jointly. So by moving a lot of stuff to Roth, we've protected the solo ager. As an aside here, I don't think the advisory world is doing a good enough job on the solo ager. Now you just had a video August 18 on solo ager, very important. But like 70% of the time in this country, it's a widow, not the widower. 70% of the time, the woman survives the husband. And we need to cater, or you guys, your organizations need to cater more and more to women and educating women about this. I educate my wife as much as I can. She has really no interest in any of this, but I take the time to point things out. I show her things on the iPad, and something needs to happen at your level to educate more women about this because of this 70% survival issue. Now, for the children, like Tom just said, the majority of the money they're going to inherit is going to be tax-free Roth. So yes, they still have the 10 years to withdraw it, but at least, unlike a traditional IRA, during those 10 years, their own earnings will not be affected in terms of taxation. And for the fourth piece is charity. We're already donating. We donate to our local church. We donate to Doctors Without Border. We donate to a couple of universities, and we'll continue to do that. But then it'll come through the traditional IRA, the qualified charitable distributions. So that will help offset that. Drew?
That's great. And just for the audience here, the qualified charitable distributions, or QCDs, EJ will be eligible for that at 70 and a half. And so that's the main threshold to pass. But I think that's a great plan. And a lot of people who are already charitably inclined, which that's who should consider these QCDs, that's some of the reason why we may not want to convert all of the traditional IRA money right away, right? And to have some left over to efficiently gift to the organizations that qualify. And it's a wonderful plan. So let's move on to this last worry here, Hans.
Yeah, the last worry is taxes, and I put that at the end because I don't want to talk about it in the beginning. I mean, it's just I have people come into us and all they want to talk about taxes, and they see us as the take the taxes away person. Yeah, and that's a bad place to start. So we put it at the end, and we've really been talking about taxes since you came on here. But what do you have to say specifically about taxes?
I didn't want to come and talk to you about taxes. I wanted to come talk to you about Medicare. And it's after I found you that I decided, hey, it made sense to not limit my discussion with an advisor about Medicare, but to understand the whole package. But taxes in retirement, they're very complicated. I mean, when you're an employee, your employer takes care of the taxes for you. You get a pay stub and you get your after-tax income to put in the bank. But in retirement, you have to deal with the taxes. I came up with 5 different taxes in retirement. In addition to state taxes, there's 5 federal taxes. There's the IRS regular marginal tax bracket, so we're familiar with. There's the Medicare surcharge, the IRMA surcharge. There's taxes on Social Security. Up to 85% of Social Security is taxed. The Medicare surcharge table is completely different from the marginal tax bracket table. I mean, they use different numbers. Then there's taxes on long-term capital gains, 0, 15, 20%, depending on when you sell your stocks, or your house, or your property, or your business. And then there's that 3.8% net investment income tax with its own confusing thresholds. Taxes are very confusing in retirement. I'm trying to make my taxes and my wife's taxes as simple as possible. So that's another overarching principle. When I'm 85 and 90 years old, I don't want to be thinking about these things. I'm going to be too confused as it is. Yes, an accountant can help, but for somebody like me who's a science guy who wants to understand this stuff, I will get confused. So I'm trying to simplify this. We're trying to minimize the taxes as much as possible in retirement. Now, is that the right thing to do? I don't know. I mean, some advisors recommend no Roth, just keep everything in a traditional IRA. Maybe they have an ulterior motive. Maybe they want to manage that traditional IRA and take 1% cut of a bigger chunk of money. I don't want to do that. I want to do Roth conversion. I mean, you recommended it, and I love that you recommended it because that's what I had in mind. Your recommendations to me back in 2023 were to do Roth conversions, and that's what I've been doing, and that's what I would have done even if I hadn't talked to you guys. I think that's the fair thing to do. You also recommended delaying Social Security till age 70. That's the right thing to do for Roth conversions. An honest fiduciary is what will tell you that you should convert to Roth. It partially depends on a lot of factors, right? It depends on when your first one's going to die. Therefore, when the RMDs are going to end up being in that single filer bracket. Depends on when your kids are going to inherit it. If they're in their prime earning years, where it's going to affect their taxes or not. And then it depends on the tax code. What if down the road, the Congress changed the tax system and now we have a higher tax rate on those RMDs? Why not get rid of them earlier on? And that's why we did what we did, primarily a Roth conversion strategy.
Yeah, I mean, when you're on that, people with Roth conversions that are opposed to them, they're doing single issue planning. I mean, for starters, they're just looking at Roth conversions and saying it makes no sense to pay more taxes now that I can postpone till later. And I think that's where we're different advisors is we're looking every time we open our mouths, we're looking at all 7 of these things. And taxes is just one of them. And that actually, Roth conversion is contrary to good tax planning because it's forcing you to pay more money now and miss out on some deductions. But when you look at the whole picture, and especially retirement income when you're older and inheritance and all that. So I think that's where people that are opposed to a lot of the things we're for, they're just looking at, single issue planning. Just kind of in finishing, we always check the boxes. And I was just thinking it's kind of pointless in this video because we've just very methodically, you have gone through all 7 of these things. But, when you're talking taxes, you're going to pay 85 tax on 85% of your Social Security if you're above a certain level. You're going to pay tax on Medicare if you in the IRMA thresholds. There's tax implications of long-term care. The IRA 401k is all about taxes. It's the money hasn't been taxed yet in most cases, and now it's going to be taxed, and a lot of people aren't dealing with that. The income is all about taxes because you can't spend the tax money. So that's why when we build financial plans, we come up with how much money do you need every month to live, and then how much do you want above that to spend on things that bring you joy. But we don't include taxes in that number because you can't spend tax money. And then estate planning, anybody that does estate planning that doesn't think about taxes. So I've just taken this one worry and gone over what we talked about on the other 6, but we would have all kinds of lines drawn. So I want to bring Drew and Tom. Do you guys have any additional questions for EJ or comments?
No, I mean, I think, EJ has been a wonderful client to work with. I think he likes learning, which we like clients like that, right? Is I want you to understand why we're recommending something, because ultimately that's going to lead you in a position where you feel more confident with the decision you're making. And so we appreciate that. Ask questions, push back on certain things. And all of this is within sort of reason, right? I mean, with the Roth conversion specifically, someone could come in and say, hey, I hear this. I want to do it all right now, convert everything right now. And a lot of times that's not the efficient way to do it either, right? So it's always sort of trying to balance these different pieces together. And that's what we did with EJ, what we do with a lot of clients is we sit down, we take a look at everything, we write out a plan that lays out sort of these different pieces, how they interconnect with each other, and we go from there. And every plan's different, right? I mean, some people come in and we might make a case on Roth conversions and they get it, they understand it, and they just look at us and say, hey, not for me. I'm not interested in doing that right now. And so we rework the plan, right? And so that's, again, it's a very collaborative approach of how we build these plans out. And it's specific to you as the client. This video has all been about EJ's experience here, but your experience will be different, right? Because your situation is different, your goals are different, your desires are different, and the plan should be different along with what those are. So EJ, we appreciate you joining and being able to share your experience, and we thank you for that.
Thank you.
on behalf of our viewers and our clients who watch these things, I want to thank on behalf of them, because I'm sure they're going to get a lot out of this.
I hope so. I mean, I'm an educator like you.
Yeah. Thank you for doing this. I know you had some apprehension at first, and
You're
this came across very well.
Good.
I'm Hans Scheil.
And I'm Tom Griffith.
I'm Drew Samala.
Thank you. I'm EJ.
Thank you very much for listening.
Thank you.
Thank you.